Okay, very good. Let me discuss. So here the scenario is given. Uh, there is an increase in sales, there is a decrease in the account receivable, and there is a decrease in the bad debt. So let's, based on this information, the company's working capital has increased. When there is a decrease in the investment in accounts receivable, the level of current asset has come down. Definitely there is a decrease in working capital, not increase. So this is wrong. Account receivable turnover has decreased. What is accounts receivable turnover? Accounts receivable turnover is equal to turnover, that means net sales, divided by average receivables, right? This is the formula. But here it is given that the sales has increased and account receivable has come down. Both this increase in numerator will increase the ratio, decrease in denominator also will increase the ratio. So this is based on account receivable turnover has decreased, is not consistent with the information given. Percentage of discount offered has decreased. There is an increase in discounts taken. So that means the discount has become more attractive. The percentage discount offered should have gone up, or otherwise somehow the discount has become more attractive, right? How, in what way you make the discount attractive? Either you increase the discount period, or either you increase the discount period, like instead of 10 days you can give 15 days, but that will really result in an increase in account receivable, right? So that's not the case. Or you can make it attractive by increasing the percentage. If you increase the percentage, the people will take more discount. But here, percentage discount has decreased, means you can expect a decrease in discounts taken. That is not what is given. So this is also not correct. So B, C, and D are definitely wrong, not consistent with the information given. Clear? So average collection period has decreased. When you say that the increase in discounts taken, that is consistent with a reduction in the collection period, because when people are taking discount and then they are paying earlier, so that is consistent with that. And then you should also know that the longer the collection period, the longer can be the incidence of bad debt. But here the bad debt also has come down. So everything is consistent with the information given. So A is correct. Next. Go through this fact pattern and what is inventory turnover ratio for year 2 and year 3. So inventory turnover ratio, any turnover ratio is turnover divided by that particular item which you're talking about. Turnover ratio, fixed asset turnover ratio is turnover divided by fixed assets. Inventory turnover is turnover divided by inventory. But here you should really try to have a numerator denominator compatibility. So for as far as inventory in the denominator is concerned, the cost of goods aspect of the turnover is more appropriate, because both are like stripped of the profit margin, right? So here cost of goods sold is the appropriate measure of turnover and average inventory. Here this is like how many times the inventory is getting turned over, valued at cost. But then you are using the same cost for here and for this in this particular case, because the ending inventory is valued at the same price. Beginning inventory also is valued at the same price, and you are not given any information other than that cost. So you can take even the quantity for the cost of goods sold as well as average inventory, because you have to value the sales at cost. So you will have to take the given cost. So if you see Year 1 it is $50 cost. Year 2 it is $50 cost. Year 3 is also $50 cost. So you don't have to multiply the number of units sold with the same cost and then divide by the same cost, because it will be a futile exercise. Even if you don't do it, you will get the same answer. So you just do with the quantity itself, it will be correct. When one of you have done it, just please pause the answer. Make sure that you are reading the question. At least this portion and this portion. This is there in the table, you will not miss it. If any of you have done the answer, got the answer, please post. Then I'll explain. Okay. Sami got C. Kevin also got C. So just listen. Please stop doing the work. Please listen, all of you. So let's start with year 3. Cost of goods sold, as I told you, 1250, and then it doesn't really have so much fun in multiplying with the same number in the numerator and denominator. So let's do with the quantity. Cost of goods sold 1200 into 50, so it is 1200 units you are selling. And then average inventory 100 units in the beginning inventory and ending inventory for year 3. So 100 is the average inventory. So 12 is the answer for year 3. So Y3 inventory turnover ratio is 12. So you go for see for year 2 and year 3. So this is the only answer possible because 12 is coming here. Right? The others are coming 24, 18. So you don't even have to do year 2. But then let's do year 2. Year 2 inventory turnover ratio 1200 is the sales number of units here. Ending inventory 100 units, beginning inventory 100 units. I am just avoiding the cost only because I see the inventory, beginning inventory and ending inventory valued at the same price. And I have not given any cost numbers for the sales, cost of goods sold, different from that. That's the only reason, right? Not that for any number you can do that, because this is all to do with the cost and the investment in inventory. But here in this particular case, 100 plus 100 divided by 2 is 100, and you are getting 12 for that. See, here in this particular case, you can work with the quantity, right? So this is the answer. So everything else is wrong. The same fact pattern. The next question is, what is the receivable turnover ratio? So when it comes to receivable turnover ratio, the denominator is with the profit margin. So the numerator also should be with the profit margin. So that you should take the net sales. But then you should be remembering that whenever you go for receivable turnover, you should take net credit sales, not the total sales. So if any of you have done the answer, please pause that and then I will explain. Sami got the answer. Others, please stop doing it and then listen to me. Receivable turnover ratio. Receivable turnover ratio is equal to net credit sales divided by average. This is the formula. Here for year 3, let's do that first. 1200 into 125 is the net sales. But what is the credit sales? This problem, especially because this 10% is given in words, 99% of students would have overlooked it. Please don't do that. 10% of Queen's net sales are in cash means 90% of this credit sales are credit. So you should take only credit sales. So 1200 into 125 into 0.9 is the net credit sales. And the average receivables are given directly, so you don't have to do any averaging exercise. 14,400 is the year 3. What you are doing is for year 3. So 1200 into 125 into 0.9 is the numerator, divided by 14,400 denominator, you will get 9.375. Look at your answers. You have unique numbers. You don't need to do year 2 then, so you got the answer. You don't have to do year 2 because 9.37 is coming only for year 2. I mean, 9.375 for year 3 is coming only for choice B. So B is the answer. But let's do year 2 also. Year 2 will be 1200 into 100 into 0.9, that's a net credit sales, 108,000, divided by average receivable is 12,000, that's 9. So you got it confirmed. But don't do that in the examination. You will only be losing your valuable time. As you got 9.375 correctly, you got it. I mean, of course, if you have time, if you're not really pressed with time, you can always do that. That's a good thing to do, especially when you are missing some numbers like 10%. Probably, like if you are lucky, you may not be getting that correct, or some choice with and without may be there in that. But here, the issue here is actually most of the students will overlook this information. 10% of Queen's net sales. That's the common mistake. Probably it seems that could be the intention of the examiner also, otherwise he should have given that 10 percentage in number, then we wouldn't have missed that. Next, question number 6. A firm has a current ratio of 2.5, quick ratio of 2. So current ratio and quick ratio are given. So difference is related to the inventory. I had told you that ratio. If you have current liabilities, immediately you can get the current assets. All that you should have it in your mind. If the firm experiences 2 million in cost of sales and sustains an inventory turnover ratio of 8, what are the firm's current assets? If any of you have done the answer, please post it and then I'll explain. By the way, cost of sales and cost of goods sold are synonyms, at least in US GAAP. Okay, Subin posted an answer B. Let's see if it's correct or not. Sami got D. So let's do that. Please stop doing the work and please listen to me. Firm has a current ratio of 2.5, quick ratio of 2.2. That means current ratio minus quick ratio is equal to 0.5, right here. See, this is 0.5. This is equal to what? Current ratio minus quick ratio is equal to 0.5. That will be equal to what? So what was the relationship I told you? If you have forgotten that, you can just derive that. Current ratio is current assets minus divided by current liability. Minus, this is current assets minus inventory divided by current liabilities, right? So this is given as 0.5. So meaning this is like current assets minus current assets plus inventory is equal to 0.5 current liabilities. What am I doing actually like this? So inventory is equal to 0.5. Yeah, this difference, right? Yeah, 0.5 current liabilities in this case, because the 2.5 minus this thing, that's the difference, right? Inventory is equal to 0.5 current liabilities. This is what we are getting it here from this information. This is one information we are having. Now what is the information you are getting it here? Cost of sales sustains, if the firm experiences 2 million in cost of sales and sustains an inventory turnover, so that means cost of sales is 2 million and inventory is equal to 8, right? This is the formula for inventory turnover. That means cost of goods sold divided by average inventory equal to 8. So that means I is equal to 2 million divided by 8. What is 2 million divided by 8? Take your calculator. 2 million divided by 2000 divided by 8 is 250. So 250,000. That is the inventory. Because of lack of information, average inventory can be taken as period inventory, period end inventory, all that. That is a common assumptions we all do. So 250,000 is the inventory. So current liabilities from this equation you can take it. Current liabilities is equal to 250,000 divided by 0.5, right? So 250,000 divided by 0.5 is 500,000. So current liabilities is 500,000, and you know that you can use that in current asset, current ratio or quick ratio. It is better to use that in the current ratio to get the current asset, because then you have less work. So current assets divided by current liabilities equal to 2.5, you know, which is given. Current ratio is equal to this thing. So current asset is equal to 2.5 into current liabilities, that is 500,000. So 500,000 into 2.5 is 1.25 million. So Sami Rahana got the answer correctly. Subin, did you understand it correctly? Okay. So Subin got B. What is B actually? That is current liabilities. But the question is current assets. Subin. Current liabilities is 500,000, but current asset, you have to apply that information in either quick ratio or current ratio and get that. Is it clear for everybody? If anybody is not clear, please raise hand. Then I'll explain you further. But I think it should be clear for you. Next. The company's asset turnover ratio for the year. What is asset turnover ratio? To find the average, asset turnover ratio Any turnover ratio will be asset turnover. Asset turnover ratio is turnover divided by assets, average assets. Average total asset is given as 1.2 million. Turnover is given as 1.8 million. Right? So what is the asset turnover ratio? 1800 divided by 1200, that is 1.5. D is the answer. Is that correct? Correct. So next question. So you are given so much information, but you should be picking up what is really required for that ratio. Then the number of days in the operating cycle for the current year. What is operating cycle? You have to look at whether it is a trader or a manufacturer. Depending on that, the ingredients of the operating cycle can change. So read the question. SE Corporation computed the following items from its financial records for the current year. Current ratio, inventory turnover, account receivable turnover, and current liabilities turnover, right? So what is the operating cycle? Current liabilities you don't need to really worry about when it comes to operating cycle, right? So current ratio is given, inventory turnover is given. From there probably you can find the inventory turnover. No, it's given. Inventory turnover days are given. So account receivable turnover. So everything is given directly, right? These are the only two things for a trader, right? Inventory turnover and account receivable turnover. So inventory turnover is 54 days and account receivable turnover is 24 days. So total is 78 days. So that is the operating cycle. So C is the answer. Is that correct? Yes. Anybody having any doubt, please raise it now. Any explanation needed, Sami?
It's clear, sir.
It's clear. Okay. Question number 9. Account receivable turnover ratio will normally decrease as a result of. So read each of the choice, whether the account receivable turnover ratio will normally decrease as a result of what is written. Just give your opinion and then post your answer there in the class conversation. What is account receivable turnover ratio? Net credit sales divided by average account receivable. This is the formula. This will decrease when the numerator comes down or the denominator goes up. So consistent with that, which choice you would choose? So you want this to decrease. If any of you have done the answer, please post the answer. I don't think there's so much computation that you people are really looking at your worksheet and trying to really work out it. I don't know what you're trying to do actually. But anyway, there can be scenarios going through your mind. You might be working out that. But please listen. I think you have taken enough time. But Sami, you want to give your answer before I give the thing, Kevin?
So I have given it's D.
You have already given.
Subin
Have you?
also given.
I thought it was the D for the previous one. Oh, okay. I am wrong. Okay, you have already given. Sorry about it. I was just waiting for. Rahana, did you also gave, right? Okay. Sorry about it. We wasted so much time. Okay. So account receivable turnover ratio will decrease when this increase or this decrease, right? It, that's the nature of that, right? The write-off of an account is uncollectible account. Assume the use of allowance for credit losses method. Here, even if you don't assume allowance for credit losses method also, in this particular case, the answer will be C. But you should know, if you haven't done your part 1 or if you are not familiar with the uncollectible allowance for uncollectible accounts or allowance for credit loss, let me tell you. When there are like you have either direct write-off method or allowances method to record the credit losses. Credit losses is the modern terminology for bad debts. So when you have the allowances method for recognizing credit loss, you will be computing the credit loss and credit loss debit to allowances. You will be creating a provision for bad debt. When you are actually writing off the debt, the entry will be to debit allowances and to credit the account receivable. So account receivable and allowance come down by the same number, and in the balance sheet there will not be any impact, right? So the account receivable will not be changing when you write off. So write off of an uncollectible account when the denominator is not changing and the numerator is not changing, there will not be any change in the account receivable turnover. But assume that this sentence is not given, then you have a benefit of doubt that the company is going for direct write-off. But that is not GAAP. In a GAAP compliant financial statement, they are supposed to follow allowances method. So even if you don't have it, you are supposed to assume. But they are specifically given. If they are giving that way, average account receivable will not change based on the write-off. So the ratio will remain unchanged. But assume that you are by mistake, actually, you are not really thinking about this allowances method, and when the accounts receivable is written off, the denominator will come down. The denominator will come down, right? The ratio will increase, not decrease. So that is also like, even if you assume that also, denominator coming down means the ratio will increase. So this is anywhere wrong. Whether you assume, you are supposed to assume, because allowances method is GAAP. Direct write-off is not GAAP. So you are supposed to assume. So it is given that you have to assume. So that's the impact on the ratio? Ratio will unchanged. Will remain unchanged. Then significant sales volume decrease near the end of the accounting period. So that means the pattern of the sales is really changing, but the total sales remain unchanged. Significant sales volume decrease near the end of the accounting period means total sales remain unchanged, but the seasonality is there that towards the end of the accounting period there is less sales. Like it seems the company has chosen a business year as the its natural business year as the fiscal year, right? Financial year. So that be the case when you have less sales volume towards the end of the accounting period, you would have collected almost all the receivables, the credit sales remaining unchanged, the average receivable come down, right? If that is the case, there is an increase in account receivable you would expect, not a decrease. So this is also not the choice. An increase in cash sales in proportion to credit sales. When there is an increase in cash sales in proportion to credit sales, right? The credit sales come down, average receivable also might come down. So how the ratio will be affected, you don't know, because both the numerator and denominator are decreasing, right? Because there is an increase in cash sales means there are only two types of sale: cash sales, credit sales. So credit sales is coming down, so credit sale numerator is coming down, denominator also might be coming down, right? Because it's a function of the sales. So how that is going to affect, you don't know. So this is indeterminable. So that is not the answer. So A, B and C are wrong. So D should be the answer. A change in credit policy to lengthen the period of cash discount means people who are sensitive about money will pay only on the last date of the discount, even if they are taking the discount. So that means their credit period is getting extended. So average receivable will go up, denominator will go up, so the ratio will reduce, ratio will decrease. So this is correct answer. Next question. Question number 10. What is the expected average collection period? So do your answer fast, and then I can see Rahna giving D as the last answer there. So let me see question number 10. Okay. Give your answer fast because we are running out of time. I have to finish off this study unit today. Okay, Sami got the answer. So please stop. Let me work out. A company sells 10,000 steak boards a year at $66 each. All sales are on credit, so there is no cash sales, right? With terms 310 net 30, so net 30 is the credit term. With 3% discount if payment is made within 10 days, that's an explanation of this credit term. Otherwise also you should be knowing about it. Then one half of the customers are expected to take advantage of the discount means one half of the customers, right? Half of the customers are going to pay it on the 10th day. So 10 days is the collection period for one half. So one half of the customers are expected to take advantage of the discount and pay on day 10. The other half are expected to pay on day 30. So other half it is 30 days. And then it is 100% sales are on credit also. So this is the mix. So what is it actually? Half into 10 is 5. Half into 30 is 15. So 20 days is the average collection. D is the answer. Clear? Sean, is it clear for you?
Yes, sir.
Okay, let's move on. If any one of you who is listening to me is having a doubt, please raise your doubt now. Next, question number 11. The day sales and receivable ratio, the DSO, the collection period, right? Day sales in receivable ratio will be understated. That means the collection period will be understated. If the company uses natural business year for its accounting period, definitely, because if you really take the natural business year, that's a period, lean period. So you will be having the lowest amount of receivable, lowest amount of inventory. That's what is called natural business here, right? So that is the correct assumption. But don't stop this thing. Let's read the other choices. And A is the answer, but let's read the other choices. Uses a calendar year for its accounting period. Calendar year for its accounting period really give us any, don't give us any clue unless we know the type of the industry, whether seasonality is affected or not, right? So you don't know. The uses average receivable in the ratio calculation. Again, if we know the pattern, then we can. Otherwise, we cannot really make any clue from that. Does not use average receivable. Again, average will be higher, or the period will be higher. So it all depends whether the company is in the growth trend or declining trend, or that nothing is given, so you cannot make any assumption just like that. So A is the only correct answer. Next, a high sales to working capital ratio could indicate a high sales to working capital ratio. So it's working capital turnover ratio, right? Would indicate what's a high working capital turnover ratio, or whenever you have a high turnover ratio, what could that indicate? Give your answer in the class conversation, then I will discuss. Yeah, you have already given. Whenever there is a high working capital ratio or very high turnover ratio, the firm is trying to overtrade, right? Overtrading means undercapitalization. They are trying to have more, higher sales with a with a low amount of capital. So when you have a high turnover ratio, you are undercapitalized. You are correct, Sami and Ragna. But let's